Welcome to S&P Capital IQ's monthly loan market update. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, the loan market stumbled slightly in late May as a result of selling pressure and a pickup in supply. Through the first 3 weeks of May, the loan market's virtually uninterrupted 2013 rally persisted. During the final week of the month, however, loan prices eased about a quarter point. The reason was twofold. For one thing, high beta names came under selling pressure from high-yield accounts seeking to build cash in the teeth of outflows. For another, an increase in loan supply helped soak up some of the excess liquidity that has long kept prices aloft. Thus, after generating a 0.5% return during the first 22 days of May, the S&P LSTA index lost 0.31% during the final 9 days of the month. All told then, the index eked out a 0.19% gain in May, the smallest monthly advance in a year. Still, with a 10-year Treasury yield up about 50 basis points in May, loans handily outperformed fixed income products. With CLO issuance still curtailed in May, visible inflows again fell short of the first quarter sky-high levels. In all, investors put $10.7 billion to work in the asset class in May, including $4.9 billion of new CLO prints and $5.8 billion in retail mutual fund subscriptions based on data from Lipper FMI. On the other side of the technical ledger, the amount of S&P LSTA index loans outstanding increased by $5.5 billion in May. But that was only the start. Owing to a slew of large M&A-driven executions in recent months, the backlog of new money loans that have allocated but not yet funded into the index stood at $33 billion by the end of May, putting further pressure on loan prices. The impact of the market's late May swoon was felt mainly in the secondary. In the primary market, by contrast, clearing yields were largely stable, with double B loans printing in a 3 to 3.5% band and single Bs in a 5% context. That said, managers were able to push back against some of the more aggressive transactions that launched in late May and early June. Dividend financing was a major source of primary product in May. Indeed, the amount of dividends financed by leveraged loans pushed to a record $7 billion during the month. Turning to credit conditions, the default rate retreated to 1.4% in May from 1.9% in April and a 28-month high of 2.2% in March. Managers are constructive on the near-term outlook. On average, they expect the rate to tick up to 1.8% or so by December, according to LCD's latest buy-side poll taken in mid-March. On the whole, the loan market has been resilient, bolstered by inflows from retail and institutional investors looking to loans as a way to hedge against rising rates. As a result, new issue clearing yields have moved up only marginally in recent weeks. Looking ahead, participants expect tone in the high-yield market to remain a key driver of loan market conditions. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. You can also download this presentation at slideshare.net.